Good afternoon. I'm Kent Kramer, Chief Investment Officer at Foster Group, and this is our regular collection of financial perspectives for the week ended Friday, May 29th. Historically, challenging times like these can be hard for investors to navigate on their own, so we're here to help. We have over 1,400 clients who we truly care for, and it's our pleasure really to help with all aspects of their financial planning, including how they plan, invest, protect, and give in uncertain times like these. If you or someone you know would be helped by talking with a firm like ours, we'd certainly enjoy that conversation. Let's talk about opening up and looking ahead. A couple topics that have to do with things that were going on this week. In terms of the opening up, a lot of things over the last week, particularly over the Memorial Day weekend. Many states had opening up plans. They're partially reopening businesses, restaurants, youth sports. Some are just slowly coming back. You can see here on the map, this was in the Wall Street Journal, those states in the kind of the orange color, they really have lifted many restrictions. A lot more activity is possible in those states, although the level of activity varies by the comfort level that people have in them in terms of going back to places of business and regular activities. The lighter blue states are ones that they have some restrictions still in place, but where they're outlined in black, they have plans to open up further. The darker blue ones are still fairly tightly regulated or constricted at this point, but they also have plans to open up a little bit at a time here going forward. In addition, there was some tension, new tension really between China and the West this week as China implemented some new regulations around Hong Kong's autonomy. That's yet to be seen in terms of what actions are taken by the US, United Kingdom, and Australia, who initially voiced displeasure over Beijing's announcements. As of May 28th, some good news on the COVID front. There were 28 potential vaccines in various stages of development and testing around the world. There seems to be news almost every day in terms of progress on the vaccine front. And even Dr. Fauci has become more optimistic that maybe vaccines could be available before the end of 2020. On kind of a negative note, US COVID-19 related deaths surpassed 100,000 this week. Globally, deaths were approaching 360,000. On the economic and financial market front, again, initial unemployment claims, something that comes out every week, but they fell for the 8th consecutive week to 2.1 million. That's still a staggering number of people. However, ongoing claims also fell. Going through May 16th, they fell to 21.1 million. So with over 40 some million initial claims, the fact that we're down to 21.1 million ongoing claims says that things are going in the right direction. US consumer spending announced this morning fell by a record 13.6% in April. Unusually, personal income actually rose 10.5% in that same time period, and that was largely due to government stimulus checks that got into people's households. GDP for the first quarter was revised to a downward 5% annual rate, but the NASDAQ approached its pre-crisis high, and other US stock markets indexes continued to recover as well this week, and you can see that in the picture here. This shows kind of three of the major US indexes, as well as the all country world ex-US, the ACWX, from the beginning of the year to the middle of the day today, Friday. And you can see the NASDAQ market is actually back in positive territory and coming close to its pre-crash market high. So a lot of recovery has happened, even though there's a lot of bad economic news, and we're going to talk about that here in a minute. In terms of the way things went this week, you can see US markets represented by the light blue had a good week. The dark purple, which is overseas markets, markets outside of the US, also had a good week. Bond market continued to do its thing, holding steady, marginally positive for the week. So really there was a jump after Memorial Day weekend. You can see that on May 26th, some positive news around states reopening and vaccine news. And then the rest of the week was mostly positive. A little bit of negative news along the way, but for the most part, investors remained optimistic this week. So some of the questions that we're hearing, one of the main ones is, hey, with all these economic numbers that seem to continue to be bad, why is the stock market doing so well? And I was fortunate to hear a presentation this week by a PhD, Wes Krill. Wes is a senior researcher and vice president at Dimensional Fund Advisors. And Wes was presenting on a topic called investing in a pandemic. And a couple of the topics that he touched on, I thought were particularly relevant to that question. Well, why would the market do so well when the economy has yet really to recover? And what he noted is that stocks tend to be forward-looking in the way that they're priced. And he put this chart up on the screen, which basically shows stock market returns 12 months in advance of GDP numbers. So if you think about what you're looking at here on the axis where you see annual GDP growth, the stock market return associated with that was actually the return 12 months prior. So what this is showing is that stock market returns, you can see by this note here in the northeast corner, what that's saying is the stock market returns 12 months prior to positive GDP numbers tend to be positive. And the point of the statistical correlation is that stock market returns tend to be forward-looking. So GDP numbers may not be that great right now, but if stock market investors think they're going to become better in the future, the optimistic investor begins to buy now in anticipation of those GDP numbers actually getting better. You can think about it this way: when stock prices are at their lowest, people are at their least optimistic. In other words, they look at that situation and go, hey, that is a situation where there is high risk and I am entirely uncertain as to when or whether it's going to get better. So I'm going to not be willing to pay very much for a stock. I'm going to drive that price lower and lower and lower because I'm going to demand a very, very high expected return because I'm taking on so much uncertainty in regards to what might or might not happen in the economy. Once some beginning kind of initial indications or green shoots start to happen with the economy, people think, okay, things are going to get better. The risk environment starts to look better, even though the economic numbers haven't really taken effect. They haven't seen that upsurge on the economic numbers. The stock market can react very quickly to that initial good or better economic news, things which seem to bode that there's going to be less risk in the future. Good news is coming, even though it might be 6 to 12 months away. So stock prices begin to go up in anticipation of that. An example would be in 2009, the stock returns anticipating 2010's GDP numbers. The equity premium, which was the stock market return less the return on a US 3-month treasury bill, which is a kind of a risk-free rate. The difference between those two is usually called the equity premium. The equity premium in 2009 was 28.1%, meaning stocks were doing extremely well, even though the economy was just entering recovery in 2009. We might be seeing something similar right now. Stock markets are going up pretty dramatically, pretty quickly, even though we have seen negative GDP numbers. They're anticipating what they expect to be positive GDP numbers in 2021. This would be like other historical periods in stock markets. This is again from Wes's presentation. And what he's showing here is after periods of intense market declines, the expected returns and the actual returns realized by stock markets after big downturns have been very, very positive. So if you remember, on February 19th through March 20th, the S&P fell about 32% here this year. So that would be that far right column. You see total return after a 30% market decline. What happens there in that kind of the lightest colored bar there, that's representing the 5-year average annualized return of the stock market after a 30% market decline, 50%. That's an incredible return. Of course, a lot of that was just recovering from the loss from the 30% decline. But the idea here is after periods of intense decline, stock markets tend to have very, very positive returns as the economy recovers. So both the charts showing how stock market prices tend to anticipate better news in GDP in the future, also pictures like this showing what's happened in the past, they seem to indicate that if history is any guide, what we'll see going forward is probably better stock market returns than what we've had in the past. There's no guarantee of that. But the idea here is that as the economy recovers, the stock market is actually out in front. So the answer to the question is, hey, why are stock markets doing so well? Why the economy seems to be doing so poorly? Is again because stock markets are anticipating what's going to happen in the future, and investors are able to respond very quickly to that, even though it takes a while for, in this case, the economy to restart, people to go back to work, and begin to see that GDP numbers actually increase. Quote for the week here. This quote is actually not from this book. I like the title of this book, Triumph of the Optimist. It's a book that describes how stock market investors through the years have been optimistic. Those optimistic investors, people who think the future is going to be better than the past, have been rewarded with positive returns. And I like this quote as well: hope is an explorer who surveys the country ahead. Again, I think it relates to what we've talked about today. People who are hopeful or optimistic about the future, they're looking forward and thinking, you know what, news is getting better and I think it's going to continue to get better. So I'm going to invest in the future. Really, as investors, we wouldn't be willing to put any of our money to work in a stock or a bond if we didn't think that the future was going to be better than the past or better than today. We're looking for a positive return. If there's not a positive expected return, why would we invest money in something that we thought was going to have a negative return into the future? Really, as investors, we all have to keep some kind of an optimistic outlook if we're going to participate in markets. Long term, historically, that's proven to be an effective strategy for investors. Obviously, there's never any guarantee as to what or when that's going to happen. But if history is any guide, maintaining an optimistic attitude as we invest, as we think about our risk tolerance, the way that we construct our portfolio, seems to be a rewarding activity for investors. Again, thanks for stopping in this week and taking some time to listen to our comments. If you have any questions that you'd like to ask, these are different ways to contact us. Also, if these things are helpful to you, if you find them to be interesting, we hope you'll pass them on to friends and colleagues. We'd love to make them available as broadly as possible. Again, please let us know if you have any questions or topics you'd like to address. We're happy to address them each week when we start to put together our topic list. Thanks again.